14th, 2021. We've got a very, very important show planned for you today. And before I get started, I want to make a suggestion. 10 years ago or 20 years ago, or I wish my accountant would have told me this kind of information, or I wish my financial planner or advisor would have told me these kinds of facts that could have helped me financially. So what I'm going to do is make a suggestion. Once you get done watching today, to anybody you know, friends, family, children, parents, cousins, brothers, sisters, listen, the information that I'm giving to you here today is updated. It's current, will help people reduce their tax, protect the downside of their investments, and plan better for their future. It's a gift that you can give to somebody else with no obligation and no cost, and it will help them. That's why I wrote the book back in 2016. That's third to make a lot of money. I think right now we make probably 3 cents per copy on a book. But the bottom line is it helps a lot of people. A lot of people have sent in information or emails and comments about how that book has helped. And that is really why I started this broadcast. So please share it. With no further ado, let's get into today's show. Today we're going to cover some very different things. The normal things we're going to cover, such as labor and tax changes, housing, stock market. But today I am going to release version 7 of our economic map. And as you've been following me through this map, all the way back to March of last year when we started this, we're at about 85 to 90% right on target with the algorithms that we built in order to track what's going on in the economy. All right, let's do an update real quick on the vaccine. The vaccine right now, as we know, is approved on December 14th. And as you see in the red, there's 153 million doses that have deployed in the United States alone since as of May 14th. And right now that has increased. You can see the red is week by week increases of the dosages per 100 people. So we're getting up there, and expected still in November that we are going to have at least a herd immunity that passes through the vaccine. Labor, well, the initial claims, well, we're doing better. We are only at 487,000 new claims as of this week. Now that doesn't really, unfortunately, doesn't really change the unemployment rate. We know that the biggest problem that we're having right now is with all this free money stimulus out there, the extra Fed money for unemployment, the stimulus checks. We've got a large portion of the labor force that would rather just sit home and do nothing. And so something has to be done. We are not a socialist country. We're not a Marxist country. We are not in that type of mentality. We are an incentive and reward country. And we got to get it back there, because otherwise this will continue. And it will have effects on everybody. The capital gains, as you probably read, the upcoming proposal is that if you have at least $1 million in annual income, now I want to classify this or clarify. Some people say, well, I don't make $1 million. But if you sell a house and you have $1 million house, that's $1 million income. If you take money out of an IRA, if you have Social Security, if you have regular income, and then if you have other capital gains, you could exceed the $1 million in total income, so that your capital gains tax rate goes from 20% to 43.8%. Now again, during Biden's administration, his run, he promised no one earning over $400,000 would pay any additional tax. At that time, I clarified, you will watch what will happen. It's not what your annual earnings are. You might have an event in 1 year that pushes you into that higher tax bracket. It doesn't mean that you are in the upper middle class. You still may be considered middle class. And remember, I said you got to be very careful. And this is not a push against Democrats, because President Bush did the same exact thing. This is a political thing, not a who sits on one side of the aisle thing. I don't trust either party. That's just my bottom line. I've seen as a tax preparer, I've seen them do things and say one thing to the public and do something completely different as to how the tax returns actually come out. We just saw that with the required minimum distributions. I've got some good news on that front, so you need to stay tuned. But we'll see you may see an increase of 20% to capital gains tax rate all the way up to 43%. And remember, you got to add on state income tax to that. One of the big things, and we're going to talk about this week and next week, is how they are going to bring back an estate tax, but it will be assessed to almost everybody that has any money. I mean, if you're poverty stricken and you don't own a house, of course not. But if you are middle class, if you are just upper class or even the high net worth, then this is going to have a traumatic effect on your financial future. Because they're also going to remove the 1031 exchange rules that will tax real estate on each transaction. In addition, the change is proposed to remove the step up in basis. This is the slide in a new death tax on people. So it's a way to get the estate tax back in. In addition, in 2025, the regular estate tax, which is right now $11 million per person. So again, right now, not many people, less than 0.3 of a percent, will pay the estate tax. So it's a very small number. However, of those people that own homes and stocks, it's estimated that 75% of people, their children will pay a tax upon death, an estate tax. It's a hidden estate tax is basically what it is. So the tax filing date. Well, I have something to really go out to everybody so that you understand that the tax deadline was pushed until May 17th. I want to make a suggestion. Do not ever file on time. I've got these people that are sending in emails and questions, what should I do? Here's my suggestion. Don't ever file on time. Ever, ever, ever. And one of the reasons is as long as you have your tax paid in that is owed, I'd rather have you wait until October to file your taxes. Why? It's your audit cycles. So there's an initial audit. If you get filed electronically versus paper, then the computers will do an algorithm to compare certain items. As an example, if you live in a $2 million house and you show no income, that will pop up as a red flag. There are certain anomalies that the IRS computer is looking for. But there's also, if you're mailing it in, somebody is taking that information in and they're scanning it and then they're doing a quick over to see if there's anything that looks weird. So by waiting until October, you bypass a lot of that scrutiny. Secondly is there's audit cycles by anomalies. So what they'll do is all the way until July. Now, let me preface this. The IRS protects their way that they audit, much like Google protects their algorithms. And the IRS will change up the way that they're doing things, just like Google does, so that no one can really figure it out. However, one thing has held true in almost 40 years is that the audit rate goes down by about 30% by waiting until October. And I know that. I mean, that's published. You can research that out there. But I know that intrinsically because that is what the rate has been different with our clients that want to get it in on time versus we delay. Now, I'm not suggesting you don't pay your tax on time. What I'm suggesting is just the return itself is filed. You'll never get away from what's called the random audit poll. This is where the computer will select arbitrarily, it's like a lottery, just to do an audit. Now, one of the big problems is that right now, there's $5 billion of the CARES Act that has been allocated towards new audits and additional IRS employees. The Biden administration right now, they're asking for $80 billion. I estimate that the audits will go up probably 300%. Because remember, audits are also used to train new IRS agents. So you may not have done anything wrong. You just kind of, unfortunately, get trapped into this thing where there's two people auditing you and one is being trained. But again, if you look at how this works, in October, the IRS doesn't have as much time because they're getting ready for the new tax year. So even if somebody is being trained, there's much less time that they have trained to do audits in October versus in April or May when they still have a 4-month, 5-month period of time until the next year is coming into play. So again, filing late does not exempt you from an audit. In my opinion, it greatly reduces the chance of audit, and that's what you're trying to do. You're not trying to hide anything. You still got to pay your tax on time, but reduce the potential for the audit. Okay, true intent. I really think with this new capital gains tax, I really think that what this is, it's designed to snare more people that are in the low income and middle income class to pay a death tax versus the way it is right now. It only affects the rich. And it's interesting how the politicians phrase it. They phrase it as it's time that the wealthy people and the super wealthy pay their fair share. Now, that's a great tagline. It's a great advertisement. But the bottom line is it's not factual. Those who have billions of dollars, they are paying estate taxes. Those who are making $200,000 a year, they bought a house maybe 20 years ago for $200,000, and now it's worth $1 million. Well, they're certainly not a wealthy family. But now when they die, the proposal is to tax the next generation on that $800,000 of gain. That is pretty bad. Well, what will this kind of tax change have as an effect on the housing market? Well, does it mean that people will start selling houses to try to step up the basis or try to get a lower tax rate? It could put more supply into the housing market, which is what we need to bring it back to some realistic numbers. But it also means those of you that are out there looking for real estate right now, it's another sign to hold off, to wait. And that is going to be represented a little bit later in today's show in the Econ Map version 7. Well, here's the good news for today. The IRS temporarily reversed a comment that they privately and very quietly put into a bulletin. So let me give you some history. January of 2020, the Secure Act passed Congress. Now, once Congress passes a law, they give it to the IRS to figure out what the code is and how to actually implement it. So during the middle of this virus, many of you that are clients of ours know what we went through. We did RMDs and Roth conversions, and then for some of you, we had to unwind them because of the Secure Act. For some of you, then we bypassed the RMDs, and then we had to, based upon what happened in July of last year, we had to redo it again. So last year was probably one of the most taxing, no pun intended, years for us in our tax department, just following all the rule changes and all the maneuvers that we were making. Well, one of the maneuvers was we had to change everybody's family trust, which is why we came up with the trust amendment package. And primarily because under the Secure Act, there was no more RMDs to beneficiaries, and there was no more stretch IRA provisions. Those two things were eliminated in the Secure Act. And basically the rule then said IRAs or any type of retirement plan passed on to a beneficiary would follow the same, or it would have a 10-year spill out or drain down rule. And what that simply means, to put it in context, if you passed away and you had $1 million and you left it to your kids, they would have up to 10 years to take the money out. So what that would propose is that we could do some very crafty tax planning. As an example, if your kids in 1 year had a very low income, we could pull more out of the IRA. If they had a high income, we could pull less out to minimize the tax. Well, then secretly, on April 9th, the IRS issued a bulletin, and basically what it said was, sorry, we are going to implement RMDs again. That means for the first 10 years that your kids inherit money, they'll still have a required minimum distribution. But by the end of the 10th year, they have to drain out all the money. Well, of course, we were pretty upset because we had just modified everybody's trusts, which means we'd have to go back and modify them again. And all the planning that we did would have completely gone out the door. Well, this is good news. That was on April 4th. So April 9th, my apologies. So that really caused a lot of backlash from really the financial community back to the IRS and said, hey, that's not fair. Come on, you put this into context a year ago and now you're changing it up, and let's have a stay on this. So here's what the IRS basically came back and said on May 4th. Here's what they stated. They didn't state that they weren't going to implement it. What they stated was not officially yet. And so what that does is it allows us to keep the current trusts in place that we did the modifications of last year. But what it also does is it gives us some period of time to now know that if we have to, we can craft new tax language in the trusts and make some really quick and immediate modifications. So right now, my estimate is that they did this just to downplay this horrific effect that this would have had to everybody that's passing away during the pandemic. It's a political move, but my estimation is that they will still implement that. If they didn't, they wouldn't come out and say not officially yet. They would state we are not going to hold to that rule. So my plan is, and our firm's plan is, that they are going to change this, but we'll be better prepared instead of them secretly and slipping this information in and hoping nobody just catches it. Okay, so our plan is this. January 2020, the Secure Act changed. We made the changes to the family trust. Recent news on the revival of the RMD, but we are waiting until the rule actually takes place. If the rule doesn't take place, then everything that you have will stay the same, assuming you made those provisional changes. Now, if you have our trust amendment package, you don't have to worry about it. We're going to contact you as soon as the change happens, and we'll implement the change for you. However, if you do not have our trust amendment package, you're going to be responsible for watching and following these changes. And when they happen, you'll need to contact us or whoever is handling your estate plan and get the amendments completed. All right. Let's get back to this great promise of not taxing those who have greater or less than $400,000. So we know that this was one of the big political stumps speeches and the agenda, but it's not true. And it's not showing true. It's not actually anywhere close to being true. So when you remove the step up in basis, you affect anybody. It doesn't mean that you have $400,000. Removal of the preferential capital gains tax doesn't affect people who are just earning. It can affect anybody who has an event. And removal of the tax-deferred exchange over $500,000, that affects a lot of people making under $400,000. So again, I would not suggest watching what comes out on political news in any medium forum, because they're only going to report what the politicians are saying. I would trust sources like ours or other sources that are more tax planning based, that understand how the outcome of these changes will really affect you. Well, how do you combat this? Well, again, we go back to our 4 tenets of tax planning. Shifting, a shift could be a location optimization where you hold the right investments into the right accounts. It could be a tax swap where you move one investment to another account to get a better tax outcome. It could be if you have RMDs, and by the way, there is now another proposal which has passed the House, but it is not law yet, to further extend the RMD from age 72 to age 75. Remember, that was a part of the Secure Act. It went from 70 and a half to 72, and now the proposal is to go to 75. And fourth and finally is an offset. That's tax harvesting. So if you have assets that are at a gain, then what we would look to do is either what's called an intentionally defective grantor trust. That is one way that we are looking at as to how to get back some of the loss and step up in basis. For sure, 664 trusts. 3 is what we're referring to as restricted living gifts. And finally, a 7702 trust. All these maneuvers are potential to reduce or shift away some of the capital gains at the rate you're at. Let's go back to the Roaring 20s. We are basically going right through the same exact, it is a little eerie and creepy that literally history is repeating itself. But if we look at what happened in the 1919 Spanish flu, the virus hits the world locks down as much as they could with the lack of information exchange. The pandemic fatigue hits, people get out and they just ignore the law. Spending spree hits, savings runs out. Now we're not there yet. So I want to give you kind of an idea where we are within within this 1920s roaring 20s playbook. We are still in the spending spree era, and it's exasperated by a huge increase in prices due to the lack of supply. Now that will change as manufacturing gets ramped up, distribution gets ramped up. That will change. But what will happen is we're going to get to a critical point where savings is going to start running out. That's what we're looking for. That's what we're tracking, is when that savings starts to run out, because that's when people will get used to spending and they will switch to debt. That's when things get bad. We saw that in 2005, 6, and 7, when people's ability to pay back debt exceeded their ability to pay it back. And we had the Great Recession where all the housing foreclosed. So again, back in 1920, we had some things that happened that were pretty devastating. We had obviously the crash in the stock market, but we have to remember, prior to that, in the 1920s, there was no Securities Exchange Commission. It was unregulated markets. And that stock market crash lasted for almost 15 years. However, during that period of the crash, there were more millionaires minted per capita of any other era in time. We just saw that. We saw the billionaires increase their financial net worth at unprecedented rates during a year of shutdown and pandemic. So again, we have to look at really, what does it mean long term? I don't believe inflation is going to be there at this current rate, and the way the markets are reacting is a little bit emotional. But if we take a look, as of today, 5/14, the S&P 500 is up 10.1% year to date. That's 134 days in. And if you look, that's 27% annualized rate of return. That's still a heck of a good year in the S&P considering where we just came from. Now, what I did today is, if you'll notice on the graph, there are some red circles. This is just since February. And you can see when we get to a market high, there's some bad news and there's some fear, and the market pulls back. Now, I want to also give you the other reason why these markets pull back. In every one of these red circles, we have to understand who you're competing against. You're competing against the hedge funds and the large institutions. Now, if you've been watching my show for any period of time, you know that back in March, April of last year, a guy named Bill Ackman, who's with Allianz, he put out a statement in the news and made it very widely known that he felt like the market was going to just totally crash. Now, he had a lot of credibility, and the markets listened. And based upon his predictions, they crashed. Now, what he didn't tell people was he had shorted the market. Now, again, I don't have these numbers in front of me, but I'm going to take a pretty close guess. He had about a $5 million bet on the short of the market, which technically turned into a $4 billion gain. So he was playing against. Now, he didn't break the law. He didn't give false and misleading. He gave an opinion, but people listened. Now, remember, the hedge funds and the large institutions will watch the news, and they can catapult off the news. So what a lot of people think is, oh my God, inflation is going to kill us. Let's move all our money to another world or another state, right, or another country. It has nothing to do. The market adjustments and the worry of inflation have nothing to do with true inflation. Look, these economists, they have a war room. They sit back. They can track when the supply is going to catch up with the demand. They can track the estimation of when housing will have more supply than demand and it will pull back. They can track when automobiles and chips will be available. They can track that. So the issue isn't that they're really worried about inflation, but they see an opportunity. So if they publicly in the media produce a fear of inflation, And then what the large institutions do is they sell out or they short. Now what happens is the media picks it up and says, oh my gosh, the market is crashing because of inflation. What do you think the average investor does? Do you know how many people have opened their own self-directed do-it-yourself accounts at, Vanguard and TD and Schwab and Fidelity, and they're sitting there trading every day and they're watching their accounts every day. And they see this in the news and they don't know any better. So what they do is they sell. That's exactly what the hedge funds and the institutions want you to do. It's completely a mind game. It's a chess game. When you sell and then the market drops, what do you think those companies do? They buy right back. Let's take a look at what just happened this week. Right? We had 3 horrible days that the market dropped. And then magically on Thursday, what happens? The Dow almost returns, right? I mean, it's not completely back, but you can't take a 2.5% drop or a 3% drop and then all of a sudden, bam, it's almost back within a day and a half. So this is the game. You got to watch out for this. So I completely believe that these markets will still crank out between a 20 and 30% rate of return by the end of the year. That doesn't look good for next year because when that spending runs out and people turn to debt, that is when we have to be worried. But right now, there has been more savings socked away during the pandemic than in any other time in history. That means people are sitting on a lot of cash. Why can't they spend it? Because the distribution and the manufacturing has not caught up with the demand. Once that catches up, we're going to see an explosion. Inflation. Again, inflation is really based upon interest rates and a combination of supply and demand. And again, that supply and demand can also be tinkered with by different industries. We see that with housing. We see lumber and steel go up 300% and 1,000%. So that is a shortage. We see when people give more money from a government subsidy like unemployment, we don't have workers showing up to build housing. So we have a shortage. However, those things change. When that unemployment runs out and when there is more supply, the price of lumber, the price of steel drop. Housing will drop. So again, this is all a cyclical effect, nothing that I would worry about on a long term from an inflationary standpoint, right? All these numbers and all these factors are not lining up to have long-term inflation, maybe 3 months, 6 months. If you would go back into the video library that we have, go through and review what I said about inflation. I said inflation would hit somewhere around May or June, and it would last through September, October. We'd have some massive inflation because of this difference, and then it will pull back. Okay, so I'm not, again, worried about this. This is a very temporary situation. And in the stock market and how that stock market follows it, I think we're at that bell curve. And when we come over the top of that bell curve, it's not going to drop back to where it is right now or at its lowest point. But we are going to have some adjustments because there is no way to sustain this kind of growth. It is an anomaly, but it's an anomaly I believe we can take advantage of because there's some offsets. There's obviously the tax situation. There's the infrastructure stimulus that may come in at anywhere between $3 to $6 trillion. And then we have the rent and the foreclosure forbearance. So again, all of these things go into play. And that is why I made some massive changes to our economic mapping. Massive meaning really so much more on the front of unemployment or employment, if you want to look at it that way. And when I feel like the circle of opportunity with real estate may be. Now, what I'm showing you on the screen right now is actually the version 6. This is what I originally predicted with the unemployment is that in 2021, we would hit some lows in January, February, March, which we did. And then it would start rebounding as we get into the summer and the places and states start opening back up again. However, there was an offset to that. And the offset is, which we knew, we just didn't know how much, was excessive unemployment and stimulus and free money is not going to help people get reemployed. So my original estimate was that the circle of opportunity would be primed towards November, December, January, February. However, with the excessive work shortage because of the excessive stimulus and free money, I'm pushing that. Now I'm pushing that circle of opportunity between January of 2022 and June of 2022. That this 3-month to 4-month workforce shortage is going to push us that far. Now, I mean, in the whole scope of things, 3 to 6 months is not that big of a deal, but it does make a big change in the algorithms. And I'm also still estimating a big change in markets and spendable income per capita based upon these income tax changes. We are going to see some devastation in families, family businesses, family farms, family ranches, just families that don't even own a business because of this loss of the step up in basis. We're going to see fire sales when people die and they don't have the money to pay the tax within 9 months. We're going to see them selling things just to liquidate, and we're going to see some real good deals out there, both in businesses and real estate. If you don't know the story, that's how the Miami Dolphins lost the Dolphins and their stadium in Miami. The Robbie family did not have an estate plan. When he died, the amount of money owed to the IRS was not liquid. So they had to sell it to, let me think, Wayne Herzenga. If I said that incorrectly, my apologies. I don't mean to offend anybody. But he picked it up on a song and a dance because they had to pay the IRS. So this is what happens. So I still do believe, while we still have a lot of money sitting in cash, that we still have a lot of punch in the equity markets, and that will probably continue into January through March of next year. Okay, then we're going to see some adjustments. So what are the actions to take? Again, if you're still sitting there believing that just 50% or some percent mix between stock and bond ETFs or exchange traded funds or indexes is going to work, it doesn't. It shows it hasn't, because a lot of the investments that are being held in them have not changed out. So if you have the S&P 500, you have 500 stocks, but life has changed. And those indexes don't change on a dime. They don't usually change for a year to 2 years. So I would be refinancing real estate. Cash out what you can right now at the low interest rates. Put the cash into a bank and get ready for the real estate opportunity. Do not hold long-term bonds. If you're looking to take advantage of this inflationary pump, what we did last July and August, we moved most of our long-term bonds to intermediate-term bonds, or we moved them to TIPS. Those are Treasury inflation protected securities. And basically what that is it takes advantage. You will make money when there is inflation. That's the way it works. And they are government backed. I would look at utilizing reverse mortgages right now when the rates are low, and then create a tax plan. Tax plan. I can't even explain to you the importance of how this will play out. Hey, lastly, before we wrap up today, if you've not yet subscribed to our YouTube channel, you can simply go into your Google and just search for H&H Retirement on YouTube. You'll find this page that you see in front of you here. Just hit the red subscribe button. And lastly, if you have any information or any questions, just give us a call, 844-702-10.